A new pipeline deal between Alberta and the federal government has reignited a national debate over Canada's energy future. After years of stalled or cancelled projects, the two governments have agreed to pursue a privately financed, low-emission bitumen pipeline connecting Alberta's oil sands to a West Coast port. It is the most serious attempt since Trans Mountain to expand Canada's export infrastructure and the most politically delicate. The agreement outlines an ambitious vision: a high-capacity pipeline, major emissions reductions tied to carbon capture, and Indigenous ownership at an unprecedented scale. Yet, behind the optimism lies significant hurdles, from financing to opposition on the coast. To understand whether the project stands a real chance, we must look at what the deal includes, what it promises, and the forces working for and against it. The plan is built around a joint federal-provincial framework that, for the first time in a decade, aligns Ottawa and Alberta behind a major oil export project. The pipeline would carry up to 1 million barrels per day of upgraded bitumen, be privately built and financed, not government-owned. It will be paired with an expanded carbon capture and storage strategy. It will include meaningful Indigenous equity and participation. It will move through a faster, simplified one project, one review approval system, and will provide Alberta with a more secure route to tidewater and global markets. The federal government is framing the project as a low-emission pipeline, something that would only be justified if Alberta significantly reduces upstream emissions through carbon capture and methane regulations. Alberta, meanwhile, is emphasizing the economic opportunity and the need for greater market access to Asia. Pipeline construction typically brings thousands of high-paying jobs. Beyond construction, stable export capacity can support long-term growth in Alberta's energy sector, driving investment, tax revenue, and royalty payments. Alberta's oil often sells at a discount because it is trapped inland. Access to tidewater could narrow the price differential and increase revenue for producers and governments alike. Shipping oil by rail is costlier and riskier. A pipeline reduces the chances of rail accidents and decreases congestion on freight lines. For Ottawa, the political cover comes from the emissions framework. The pipeline is tied directly to carbon capture and storage, methane reductions, and carbon pricing equivalency. Supporters argue that this could reduce Alberta's overall emissions footprint, even as energy exports grow. Many First Nations have signaled interest in equity stakes in energy infrastructure. Proponents say this project could create long-term revenue streams that support self-determination and local economic development. While some Indigenous groups support resource development, several BC First Nations have already voiced opposition due to tanker risk and the lack of consultation. Without coastal First Nations consent, not just Alberta's, the project could be legally vulnerable. Critics argue that any new fossil fuel infrastructure locks in emissions for decades. They question whether carbon capture and storage is meaningfully offset, increasing production, or whether it provides political cover for continued expansion. Global oil demand projects are shifting. If demand plateaus or declines, a multi-billion-dollar pipeline could become a stranded asset, with private investors reluctant to take on risk. Even with streamlined processes, major energy projects in Canada face years of legal scrutiny, particularly when multiple jurisdictions and Indigenous rights are involved. Court injunctions alone could add years of delay. While the project must be privately financed, energy companies have become cautious over the cost overruns and public controversy surrounding the Trans Mountain expansion. Convincing investors to fund a new line will not be simple at all. Predicting the fate of Canadian pipeline projects is fraught. They tend to be either unexpectedly revived or dramatically derailed. Still, based on political and industry dynamics, several points stand out. Ottawa and Alberta are aligned, something not seen in a decade. Indigenous equity partnerships are increasingly common and politically powerful. Global demand for heavy crude remains steady, especially in Asia. The emissions-tied framework may neutralize some federal political resistance. Coastal First Nations opposition could be decisive. Private investors may hesitate unless long-term demand is guaranteed. Environmental litigation in federal provincial jurisdiction conflicts with delay approvals. Global decarbonization and price volatility may weaken the financial case. While the political cooperation between Ottawa and Alberta is real and significant, the structural obstacles remain steep. Without clear support from coastal First Nations and explicit private sector commitment, the likelihood of the project reaching construction remains uncertain. A realistic assessment is that the project has moderate political momentum, high economic upside, but very high regulatory and financial risk. In other words, the deal is a breakthrough, but the pipeline itself is far from guaranteed. The Alberta-Ottawa Pipeline Agreement is a turning point in Canada's long-term battle over energy infrastructure. It signals a new era of cooperation, links development to emissions reduction, and attempts to balance Indigenous involvement with economic opportunity. But it is still a promise, not a project. The next 12 to 24 months will determine whether this becomes a transformational national undertaking or just another ambitious pipeline that never makes it past the blueprint stage.